Every fortune begins with one decision: to understand money instead of chasing it. The stock market has been the engine of that understanding for centuries. It's where ideas become companies and companies become legacies. But to beginners, it often looks like chaos. Numbers flashing, charts spiking, traders yelling. In this first chapter, we'll cut through the noise and uncover the truth. What is the stock market really? At its core, it's the world's biggest marketplace of ownership. When you buy a share, you're buying a slice of a real business. Picture the New York Stock Exchange as a global meeting point for investors and companies. Companies list their shares through an IPO, initial public offering. Investors buy those shares hoping the company will grow and increase in value. Every transaction reflects a simple law. Someone believes tomorrow will be worth more than today. But markets don't just move on math. They move on emotion. Fear and greed drive more candles than earnings reports ever will. Understanding the psychology behind price movements is as vital as knowing the numbers. Every trading day, billions of shares change hands. Behind that activity lie two types of participants: investors and traders. Investors buy ownership for years while traders capture shorter-term price movements. Both play essential roles in the ecosystem. Investors bring stability, traders bring liquidity. Price changes because of supply and demand. When more people want to buy than sell, price rises. This dance of bids and asks forms what we see as candlesticks on a chart. Green for optimism, red for caution. Every candle tells a story of human emotion: hope, doubt, conviction, and fear. Reading those stories separates gamblers from traders. Why risk money in a system that moves every second? Wealth is built not by working harder, but by letting your money work while you rest. History proves it. If you invested $10,000 in the S&P 500 in 1990 and held on, you'd have over $100,000 today. That growth comes from compound interest. Einstein called it the eighth wonder of the world. Each dollar earns another, and those earnings earn more. A quiet, relentless process. People invest for different reasons: retirement security, education, or financial freedom. But underneath every goal lies the same desire: control of time. Money invested wisely buys you time to live on your own terms. The stock market isn't just one place. It's a vibrant ecosystem filled with diverse players and products. Retail investors are everyday folks like you and me, while institutional investors are the big players: hedge funds, mutual funds, and pension funds. These giants can sway markets, but at the end of the day, we all share the same goal: profit with protection. Beyond simple shares, we have ETFs, which are baskets of stocks that track an index, making investing more accessible. Then there are mutual funds, professionally managed pools of investor money designed to grow your wealth. Options and futures are contracts that bet on price movements, powerful tools when used wisely, but risky if mismanaged. Think of the market like an ocean. Day traders are the small waves. Institutions are the large tides. Global economics is the undercurrent. You can't control the ocean. You can learn to surf it and navigate its challenges. Before you dive into trading, let's talk about the essentials you'll need. First up, a brokerage account. This is your gateway to buying and selling stocks. Choose one with clear fees and a user-friendly interface. Next, get some charting software like TradingView or Thinkorswim for your analysis. Stay updated with reliable news sources like Bloomberg or Yahoo Finance. But remember, don't get overwhelmed by the noise. A notebook or digital journal is key. It's your trading diary. Success isn't just about having the right tools. It's about using them consistently.
Imagine your favorite startup. Maybe it began in a garage or a dorm room. It starts as a dream, fueled by savings and friends' support. But one day, it grows big enough to need the world's capital. That's when it goes public. Today, we'll explore how that happens, the initial public offering, or IPO. It's the moment where private ambition transforms into public opportunity. Every major company, Apple, Amazon, Tesla, once started privately owned. Founders and early investors held all the shares. As businesses expand, they need massive funding to build factories, hire talent, and reach new markets. Private investors alone can't always cover that scale, so they turn to the public, inviting everyday people to buy ownership through shares. That's what an IPO does. It converts private equity into publicly traded stock. Going public isn't just about money, it's about credibility, transparency, and legacy. A listed company must now answer to shareholders and regulators. Let's walk through the real sequence behind the headlines of an IPO process. Step 1. The company's board and management analyze if they're ready to be public. They review profits, growth prospects, and corporate governance. Step 2. They choose underwriters, like Goldman Sachs or Morgan Stanley, who price the shares and resell them to the public. They bridge private vision and public investors. Step 3. In the U.S., companies file Form S-1 with the SEC, detailing everything from revenues to future plans. Transparency is key. No secrets allowed. Step 4. Executives tour major financial centers, pitching to institutional investors. It's storytelling meets numbers. They must convince the world that this company is worth owning. Step 5. After gauging demand, the final IPO price is set. On listing day, trading opens, and the world gets its first taste of public sentiment. Some IPOs soar, others stumble. But each marks a new chapter. Ownership democratized. When you buy IPO shares, you're purchasing equity, partial ownership of a company's future. But there are nuances to consider. Primary shares are issued by the company to raise fresh capital, while secondary shares are sold by early investors who wish to cash out. Not all IPO proceeds go to the company, some go to previous shareholders. This mix affects long-term potential. A high ratio of primary shares means growth capital, while a high ratio of secondary shares indicates early exits for insiders. That's why research matters more than hype. Read the company's prospectus. It's the script of their future. How does anyone decide a new stock's worth? Through valuation models, a blend of art and science. Underwriters evaluate earnings per share, revenue growth, and future cash flow to estimate a fair range. Yet, final pricing often depends on demand. If institutional investors rush to reserve shares, the price rises. If sentiment cools, it falls. Remember, the IPO price is a promise, not a guarantee. The motives behind an IPO aren't always identical. Here are the most common: raising capital, liquidity for early investors, brand visibility, and talent retention. But going public isn't without sacrifice. Public companies face quarterly scrutiny, reporting obligations, and investor pressure. Going public is not the finish line, it's the start of a marathon under stadium lights. For investors, IPOs can be thrilling, but they come with volatility. Prices often surge on debut day, only to drop as excitement fades. Insiders usually have a lockup period, preventing them from selling shares for 90 to 180 days post-IPO. When that lockup expires, supply floods the market, sometimes pushing prices lower. Not all companies are ready for public life. Some debut with hype, not solid fundamentals. When the curtain lifts, reality can catch up fast. Here's a rule of thumb. Don't buy the story, buy the numbers behind it, study financials, understand the sector, and wait for stability before committing large capital. A few IPOs have changed the world. In 1980, Apple debuted at $22 a share. Adjusted for splits, that's less than $1 today. In 2004, Google's Dutch auction IPO rewrote pricing rules. 2012 saw Facebook rise to a $1 trillion firm despite technical glitches at NASDAQ. In 2021, Coinbase mirrored the digital finance era with its public debut. Each story shows one truth: public markets amplify both success and accountability. Before investing, break the prospectus into 5 key areas. First, the business model. What problem does the company solve? Is demand growing? Second, financials. Look at revenue trends, profit margins, and debt ratios. Third, the management team. Do the leaders have a track record of execution? Fourth, the industry landscape. Is it competitive or dominated by monopolies? Finally, valuation. Compare to peers. Is the IPO price fair or inflated? Then check market sentiment, macro trends, interest rates, and sector momentum. Even a great company can stumble if the timing is wrong. In recent years, companies have found new paths to the market. Direct listings allow firms to sell shares directly to the public, like Spotify and Slack. SPACs, or special purpose acquisition companies, merge with private firms for a quick listing. These methods reduce costs but carry different risks, like less scrutiny for SPAC investors. The takeaway? Know the path your investment took to reach you. It often predicts performance. An IPO isn't a lottery ticket. It's an invitation to a long-term journey. Approach it with discipline. Don't rush in because of media hype. Set allocation limits. No single IPO should dominate your portfolio. Revisit your investment thesis after 6 months. Most importantly, see each IPO as a lesson in capital formation, not just a chance for profit.
Behind every IPO bell, there's a story waiting to be told. Of late nights, risks taken, and unwavering belief. Founders share their dreams with the world, and investors choose to believe in them. For you, the lesson is clear. The stock market isn't just about numbers. It's a stage where ambition meets faith. In our next chapter, we'll dive deeper, learning to read financial statements, decode fundamentals, and uncover true value beyond the noise. Until then, stay curious, stay patient, and remember, every great investment story starts with a company brave enough to go public.